Hey everyone, welcome back to Corporate Decoder. Today, United Parks and Resorts Incorporated just filed its quarterly report for the second quarter of 2026, and we are seeing a dip in revenue that needs a closer look. Quick note, this is not financial advice, just my take on public filings for educational purposes, while they are seeing some per-person spending increases. The overall attendance drop is a big red flag for theme park companies. Alright, let's dive into this 10Q filing from United Parks and Resorts Incorporated. This is their quarterly report giving us a snapshot of how the company is doing between April and June of 2026. First up, the balance sheet. This is like a company's financial photograph. On the asset side, we see property and equipment, which makes sense for a theme park company with all their rides and attractions. They've got over $4.2 billion in property and equipment, but their cash and cash equivalents took a big hit, dropping from almost $100 million at the end of last year to just over $19 million now. That is a massive decrease. On the liabilities side, long-term debt is significant, over $2.2 billion. This means they owe a lot of money for a long time. Now let's talk about how they make money, starting with revenue. For the 3 months ending in June 2026, admissions revenue dropped by about $11.7 million compared to last year, down to $244 million. This is a 4.6% decrease. This drop is happening because fewer people are coming to the parks. Attendance itself is down too. For the second quarter of 2026, they had about 179,000 fewer guests than the same time last year, a decrease of nearly 3%. The report mentions an unfavorable calendar shift and a dip in international visitors. Essentially, fewer people are buying tickets. But here is an interesting part. Even though fewer people are coming, those who do show up are spending more inside the parks. In park per capita spending, meaning how much each person spends on food, merchandise, and other things, increased by 5.1% to nearly $40 per person. This is a positive sign, showing that the visitors who are there are opening their wallets more. Overall, total revenues for the quarter are down slightly by about $6.9 million to $483 million. This is a 1.4% drop, and it is mainly because the drop in admissions revenue was not fully offset by the increase in in-park spending. On the cost side, operating expenses went up. For this quarter, they increased by over $10 million or 5.3% to $215 million. A big reason for this jump is mentioned as non-recurring third-party labor and consulting costs related to damage from a winter freeze in their Florida parks. This is a one-time hit, but it still impacted their profitability for the quarter. With revenues down and expenses up, operating income took a significant hit. It fell by over $23 million or 16.6% to about $117 million. This shows that the combination of fewer guests and higher costs squeezed their profits. And this flows down to the bottom line. Net income for the quarter dropped by over $16 million, a 21% decrease to $63 million. Looking at the first 6 months of 2026, the picture is similar. Total revenues are down by about $15.5 million to $761 million. Net income for the first half of the year is down substantially by over $34 million, a 54.4% decrease to $29 million. This is a pretty steep drop. A consistent expense is interest. They paid about $64 million in interest in the first 6 months of 2026. While this is down slightly from last year, it is still a huge number and a significant drag on their earnings. Now, let's talk about where the company is investing for the future. Capital expenditures, which are basically investments in their parks, were $138 million for the first 6 months of 2026. This is up from $110 million last year. They are investing in new rides and attractions, which is crucial for a theme park business to keep guests coming back. Looking at cash flow, they generated $236 million from operations in the first half of 2026. This is up from the same period last year, which is a good sign, showing that the core business is still bringing in cash. However, their financing activities show a large outflow of cash. They spent over $220 million on repurchasing their own stock in the first half of 2026. This is a significant amount of money that could have been used elsewhere, like investing in new parks or reducing debt. Regarding their debt, they have a substantial amount outstanding. As of the 30th of June 2026, they had over $1.5 billion in Term B -3 loans and $50 million drawn on their revolving credit facility, while they have access to a $700 million revolving credit facility. A large portion of their debt is variable rate. This means that if interest rates go up, their interest expenses will rise too. They also have covenants, which are basically rules they have to follow as part of their loans. One important one is a maximum first lien leverage ratio. They need to keep this ratio below 6.25 to 1. As of the 30th of June 2026, their net total leverage ratio was 3.55 to 1. which means they are currently in compliance with that specific covenant. On the legal front, there is an ongoing dispute with Sesame Workshop. Sesame Workshop has sued them, seeking to terminate their license agreement. This is a significant legal battle that could impact their ability to use the Sesame Place brand. The company is fighting this in court. So, what is the big picture here? United Parks and Resorts is facing some real headwinds. Declining attendance is a major concern for any theme park operator. While they are managing to increase per person spending, it is not enough to offset the drop in visitors. The significant debt load, coupled with rising interest expenses if rates climb, is also a worry. The legal battle with Sesame Workshop adds another layer of uncertainty. On the plus side, they are continuing to invest in their parks, which is essential for long-term growth. But right now, the focus needs to be on driving attendance back up. That is my take. Stay decoded. If you found this analysis valuable, hitting that like button really helps, and subscribe for more deep dives. The research tools I actually use are linked in the description.